All right, let's dive right into this explainer. Look, if you've ever stared at a chart and just felt completely lost in a sea of conflicting signals and lagging indicators, the source material we're unpacking today is going to be a massive eye-opener. We are exploring that huge, often frustrating gap between perfectly neat textbook theories and the messy, highly emotional reality of live markets. So, the core question this material asks is, how do we actually filter out the noise? Because the secret definitely isn't learning every single indicator under the sun. Actually, it's about understanding exactly which category of tool fits the specific market condition that's playing out right in front of you. Here's our roadmap for today. 1. Essential tools for every trader. 2. Identifying key market levels. 3. Tracking trends and momentum. 4. Applying theory to real markets. 5. Risk management and psychology. And finally, 6. The ultimate trading challenge. Okay, Section 1. Essential tools for every trader. Categorizing the chaos. It's really all about grouping these strategies so the chaos becomes, well, digestible. Instead of getting chopped up in traditional candlestick noise, shifting over to Heikin-Ashi or time-agnostic Renko charts can suddenly make the trend crystal clear. You've got your patterns mapped out for breakouts like wedges and triangles, alongside wave theories like Elliott's 1, 2, 3, 4, 5 sequences or harmonics. It just provides a really neat toolkit for virtually any scenario. Now, this part of the research is actually pretty wild. It mentions unconventional tools like moon phases. I know, it might sound a bit out there, but some traders literally correlate lunar cycles with human emotions, like viewing a new moon as a bullish signal and a full moon as bearish. It just goes to show the sheer vastness of the trading toolkit. Moving right along to Section 2, identifying key market levels, finding the bounce. When you're trying to figure out exactly where price is going to react, mechanical tools like Fibonacci offer some incredibly strict rules of engagement. It's a simple process. You spot the swing low and swing high, drag the tool, and then you just wait for the pullback. The 0.382 level is highlighted in the data as that classic prime location where pullbacks historically reverse and continue the main trend. But it's not just fibs, right? The data also points to your classic horizontal support and resistance, as well as dynamic support from moving averages. What's really interesting, though, is the focus on fair value gaps, those massive candle imbalances that act like absolute market magnets, and supply and demand order blocks where the institutions have historically left their footprints. All right, Section 3, tracking trends and momentum, gauging market strength. The material draws a really hard line here based on market conditions. If you're in a ripping trend, momentum indicators like MACD crossovers or the super trend are your best friends to keep you in the move. But if you're in a choppy, sideways market, relying on those same momentum tools is just inviting false signals. That's exactly when the data suggests flipping over to oscillators, like the RSI or stochastic, to play the overbought and oversold extremes. To visualize a sideways choppy market, just imagine a tennis ball trapped in a room. It hits the ceiling, that's your resistance, and bumps down. Then it hits the floor, your support, and bumps back up. It's a literal ping-pong match. When the market is trapped in this room, your whole strategy has to shift from expecting massive breakouts to simply trading the bounces, or honestly, just staying out of it until the room finally breaks. Which brings us to Section 4, applying theory to real markets, the battlefield. Here's where things get real. A textbook breakout looks beautiful on paper, right? Sudden, sharp movement right out of consolidation. But the real-world application? Yeah, it's rarely that clean. You might enter a perfectly valid setup only to find yourself sitting through a grueling 90-minute sideways grind. Your heart rate is up, you're sweating every single tick, and ultimately, the market just fizzles out, forcing you to cut the trade at break-even. And you know what? Break-even trades are a completely normal part of a professional trader's life, even when the setup was flawless. Real-world trades also show us that different markets have entirely different personalities. Based on recent live market observations, trying a direct breakout on an index like the Nifty can be incredibly risky. Instead, retest theory works wonderfully there. You let it break, let it pull back, and then you buy. Conversely, for individual stocks like Tata Motors, direct breakouts often crush it and hit their targets swiftly. And Forex or gold, those markets are absolute fake-out city, making strategies that capitalize on trapped liquidity sweeps highly effective. You simply have to adapt your strategy to the asset you're trading. Let's hit Section 5, risk management and psychology, the trader's mindset. To really hammer home the reality of execution, the source highlights a recent gold trade. A fantastic 2-minute setup resulted in a painful $1,000 loss. simply because of a super common psychological trap: entering on an open moving candle instead of just waiting for it to close. The market reversed, hit the stop, and brutally, the very next trade hit a stop loss too.
And this leads to one of the most vital takeaways from the material: absolute acceptance. The trader who took those consecutive losses noted that you have to just accept them. Quote, "Stop losses are a normal part of a trader's life. You have to keep accepting them without taking any revenge, without being angry. You just have to close the laptop." Taking hits is simply the unglamorous cost of doing business.
Listen, preserving your capital through those small losses is what sets up the opportunity for massive gamma moves. Check out this nifty trade highlighted in the data. Following a bullish wick on the open, an explosive green candle netted over 533,000 rupees in profit. One highly targeted, outsized win, completely wiping out a week's worth of paper cuts. And that takes us to our final stop, Section 6. The ultimate trading challenge: prove your skills. So all these theories and psychological skills, they're actually being put to the ultimate test in a brand new reality game show set in Dubai, running from July 15th to August 15th. The big catch? You have to use your own real money. Demo accounts are strictly banned because, let's face it, paper trading just doesn't simulate real fear and greed. The whole competition is judged purely on return on investment, so the size of your account doesn't matter, just your raw percentage gains. The top 50 traders with the best ROI are going to get flown out, interviewed, and featured on the show. Ultimately, all of this research boils down to this one thought: we can learn the theories, we can study the messy reality, but can we actually execute? When real money is on the line, the demo accounts are gone, and a $1,000 loss is staring you right in the face. Do you have the discipline to stick to your process? Because the true challenge isn't beating the market, is it? It's mastering yourself. So are you ready for it?